All right, welcome to Module 2 of Accounting 503. The technical title of the chapter is Determination of Tax, but we really get involved in a number of other things within this module. So you're going to see that the videos are broken into 3 parts. You're currently watching Part 1. Don't forget to go through Parts 2 and 3 as well. So a lot of video lecture for the week. All right, let's start with calculating individual income tax. So we're going to start with a few terms. So recognized means that we've taken that item, that transaction, and we have reported it on a tax return as part of taxable income. Gross income is income that is recognized. Excluded income is income that is not part of gross income, so it's been excluded for some reason. Adjusted gross income is income that's been adjusted by a variety of deductions that are provided by legislative grace and are generally not thought to be affected by ability to pay. Deductions for AGI are the deductions that you get before AGI. So when you're doing a subtotal, deductions for AGI come before AGI. You can contrast that with deductions from AGI, which are deductions that occur after that subtotal of adjusted gross income. Taxable income is the amount of income that is subject to income tax. So that's our tax base in an income tax system. All right, so this should look familiar because we covered this last module, right? So this is the individual income tax formula. And we're going to start to tear this down a little bit today. But really, it's really over the course of the entire semester that we dig in on each one of these items in a pretty meaningful way. So let's start with gross income, even though there are 2 chapters in the next module on this. Apparently my Java update is available. I hope you guys are excited. I know I am. Gross income is a very broad definition for tax purposes. It's intended to sweep in almost all forms of realized income. So, Ren buys a stock at $10 a share. The price goes to $12 per share. I think we can argue that for sure Ren has income. He's $2 better off than he was. Now, when Ren now sells those shares for $12, does he have income? And the answer is, well, yeah. The difference between these two is the realization event, right? So Ren has realized income in the second one, where in the first one, where the price has just gone up, he has unrealized income. The basic rule is that all income is gross income unless we tell you different. And really, I'd alter that slightly and maybe say that all realized income is gross income unless we tell you different. And in this case, we is the tax law. So, and again, we'll spend a lot of time on gross income in the next module because there are 2 chapters devoted to that topic. So deductions are these items that reduce our gross income, right? They reduce our taxable income as a result. And they're granted as a matter of legislative grace, except for cost of goods sold. Technically, under the tax law, cost of goods sold is in fact a adjustment to gross income in any event. Deductions come in 2 flavors, for AGI, which we talked about already, and from AGI. So in Pennsylvania, the legislature has decided there should be a deduction for the purchase of grapefruit. And they've decided that because for some reason or another, the legislature has decided we need to stimulate the demand for grapefruit. And so the question that Congress is facing is, should that deduction be contingent on ability to pay? Recall that when we discussed vertical equity in the last module, we talked about vertical equity being tied to this idea of ability to pay. Those with a greater ability to pay should pay more. Whether you believe that constructively or not, it's part of our federal income tax system. So the question that they're trying to answer is, should an affluent taxpayer receive a deduction for their purchase of grapefruit, even though they could already afford all the grapefruit they wanted, right? So a truly affluent taxpayer could have bought grapefruit and had it for breakfast, lunch, and dinner every day, and there's no real reason to lower the price for that affluent taxpayer because legitimately they could afford it, whether there was some sort of tax deduction for it or not. Now, that's not to say they won't take it once there is. So Congress decides no. So then the answer is, well, what's the limit, right? How are we going to define what limit we're going to apply to determine whether or not you get to deduct the purchase price of your grapefruit? And the subtotal that Congress comes to again and again and again is the adjusted gross income. This is used as a barometer of ability to pay with respect to a number of deductions. So, for example, Congress might say, okay, well, if your adjusted gross income is less than $40,000, then you can deduct the cost of your grapefruit. If your AGI is more than $40,000, then you're not eligible to deduct the cost of your grapefruit. So typically, this is not 100% true, but typically for AGI deductions, those are deductions that come before the adjusted gross income subtotal, they're not dependent on income, right, which is a measure of ability to pay, whereas from AGI deductions, almost exclusively are based on the ability to pay, and therefore are based on some percent or some form of AGI. So what are some of the common for AGI deductions? And as you recall, last module we went through Schedule 1 of Form 1040. And if you look at the bottom of Schedule 1 of a Form 1040, you can find virtually a list of the common for AGI deductions because that's where you would normally report them. So some of these we're going to cover today and some we're going to defer until we cover those items in more detail in later chapters. So educator expenses, health savings accounts, moving costs, we're going to cover those today. Later on, we'll cover 1/2 of self-employment tax. We'll talk about contributions to IRAs for individuals and self-employment retired contributions. We'll talk about alimony today, and then we'll defer student loan interest until we get to Chapter 6. Okay, so let's dig in on these few AGI deductions we want to talk about today. Well, not we so much as I guess maybe I want to talk about today. So what is the educator's expense? This is a pretty narrow AGI deduction. Deduct up to $250 for out-of-pocket expenses for school supplies. So only an eligible educator can take these deductions. An eligible educator is a kindergarten through grade 12 teacher, instructor, counselor, principal, or aide who worked at least 900 hours a school year in a school that provides elementary or secondary education. So, for example, I am not eligible for the educator's expense deduction. This is a for AGI deduction. So the idea is, look, if you're a school teacher and you spent $250 out of your own pocket for supplies, you can deduct them. And it really doesn't matter. That's true if your spouse makes $1 billion. It's true if you're single. And it's true if your spouse makes no money at all, right? So it's not contingent on the amount of income you have, right? It's not contingent on your ability to pay. So if you're married filing joint, then you can deduct up to $500, but both spouses need to qualify as eligible educators. And I know many of you are probably familiar with the idea of married filing jointly. Later on in this video, we get into filing status. But for now, kind of assume that you could either be single or married, and you could file jointly. So if both of you are eligible educators, that's up to $500. So let's think about the deduction if A and B are spouses, they're married filing jointly, and each spends $300, right? So because the limit is $250 per individual, A and B would collectively take a $500 for AGI educator's expense deduction. So that's $250 for A and $250 for B. So if A and B are married filing joint and A spends $100 and B spends $400. Well, this is interesting because under the tax law, their deduction collectively is $500. However, because A only spent $100, A can only include $100. B spent $400 but is limited to $250. So A and B's joint deduction for educator's expense would only be $350, not $500. So if A and B are married filing jointly and each spends $100, well then, of course, they'd each take $100, so their joint deduction would be $200. And lastly, if A and B are married filing jointly and A spends $300 and B is not an educator, then B's eligible amount is $0 and A's eligible amount is up to $250, and so their joint deduction would only be $250. Okay, so before we leave this slide and move on to the next topic, let's go back to that second item where A and B are married filing jointly. A spends $100 and B spends $400. Let's talk pragmatically about how that would work out, we think, in real life, right? So somehow B's got to find a way to classify some of that spend as A's, right, to get up to the $250. Now, I don't know whether that's plausible or not, but that's probably one of the tax planning scenarios they engage in, is they trying to find a way to classify some of that expense as A's. So let's take a really basic example and say if they were buying supplies, construction paper, right? Well, probably what they'd allege is that, half that construction paper was for A and half of the construction paper was for B. If, on the other hand, it was for things that they posted on their bulletin board or some sort of cost that you could trace directly to a classroom, then A and B are going to have a much more difficult time justifying that they did, in fact, spend that money equally as opposed to B spending more. Okay, so let's leave that behind and talk about health savings accounts. So health savings accounts, and when we get to Chapter 9 on compensation, we'll talk extensively about this idea of lock boxes. Now,
Jim, under my plan, I will put Medicare in an ironclad lockbox.
They're not really lock boxes. There is no such thing as a lockbox in the tax code. But there's a lot of policy that emulates an
ironclad
lockbox type idea, and health savings accounts are one of those.
Lockbox.
So this is an account that a taxpayer can contribute money into. And so long as they use that money for health expenses, they don't have to include that amount in income. So basically they take a deduction for it when they contribute it in, and as long as they spend it on medical expenses, they don't have to include it in income when they pull it out. And that's true of their contributions plus any income that's been earned in that health savings account while it's held the assets. So contributions are limited to certain dollar amounts depending on age and whether insurance covers an individual or a family. And earnings and unused contributions accumulating in the HSA are not taxed. And again, distributions to cover medical expenses are also not taxed. So how do you get an HSA? Because this sounds like a pretty good deal, right? Well, yes and no, right? HSAs are only available to taxpayers that have high deductible insurance plans. So the idea is, look, high deductible insurance plans are less expensive than standard health insurance because what's happening is you have to pay a much larger part of the cost that you incur. And so what happens is the government opened up these plans to say, hey, okay, I get it. You're work at a place that has only a high deductible health care plan. So why don't we give you an opportunity to shelter some income, right? So go ahead, take a deduction if you contribute to this HSA account, and then as long as you pay those funds out to cover medical expenses, you don't have to include them in income. So the idea is this would be designed to encourage taxpayers to, of course, carry health insurance because that's better for the government because, of course, who pays for health expenses when you're uncovered? And somehow the government generally does that. So the 2018 limits for what you could contribute to an HSA are $6,900 for a family and $3,450 for an individual. And the health insurance plan itself has to notify the taxpayer if it's considered a high deductible plan. That's not something that judgment necessarily weighs in on, right? So there's no like, those deductibles suck. I'm in a high deductible plan. I'm opening up an HSA. So a lot of employers that operate high deductible plans make HSA accounts available to their employees as a payroll deduction, right? That's a very common way for an HSA to exist. The other way is self-employed individuals who end up having health insurance, but they have a high deductible plan. They often set up an HSA for themselves. Okay, so moving expenses for years and years and years have been deductible, and the idea is to promote mobility of the workforce in the United States, and it ties into ability to pay, right? So arguably, if you've had to move and your employer's not reimbursing the costs of that move, moving is expensive, and so as a result, that lowers your ability to pay, and so moving expenses were deductible. That is no longer the case. Unless you are a member of the Armed Forces of the U.S. on active duty and your move is pursuant to a military order and incident to a permanent change of station. So no one but Armed Forces now can take a moving expense deduction. And when we get to gross income, we'll see it also used to be if your employer paid for your moving costs, you didn't have to include that in your income. Again, that's no longer the case unless you're in the Armed Forces. All right, alimony is something that gets a lot of news. I can see why, right? It makes good press. But alimony is a separate maintenance payment or similar periodic payment made to a spouse or former spouse. And there are some requirements to qualify as alimony. So the first, those payments must be made in cash and must be received by the former spouse. So they can't be payments in rent paid to the spouse's or the ex-spouse's landlord, for example. The payments must be made under a written decree of divorce or separate maintenance, or under a written instrument incident to divorce. So what they're saying here is, look, these payments have to be documented in order to be treated as alimony for tax purposes. You can't just say like, oh, my ex-spouse pays me $100 a month, and we're calling that alimony. No. Like it has to go through the divorce or separation process. So the payer must have no liability to make payments for any period following the death of the spouse receiving the payments, because obviously that must not be a maintenance payment if you keep paying it after the spouse dies. This is usually tied up in child support, right? So child support is separate from alimony. If you're paying a spouse and that money is for child support, that's not treated as alimony. And the payments must not be designated in this written agreement, right, this decree or separation agreement, as anything other than alimony. And lastly, if the parties are divorced or legally separated, they must not be members of the same household when these payments are made. So the idea is, hey, we're divorced, but we live in the same house. Well, there can be all sorts of income shifting associated with the expenses of owning that home. And so as a result, the IRS just says, nope, you don't have alimony if that's the situation, the environment you're living in. So under previous tax law, alimony was deductible by the payer, but it was includable in income by the recipient. So it was actually an income shifting system by which the person who paid the alimony deducted it. The person who received the alimony included it in income. So the tax law change at the end of 17 repealed alimony provisions, and no longer do you deduct these, and no longer do you include these. However, there's a little bit of a transition period. So the effective date of this change was for divorce and separation agreements after December 31st, 2018. Any divorce or separation executed on or before December 31st, 18, or modified after December 30, 2018, if the modification expressly provides that the amendments made by the tax change apply, then, of course, that means that this repeal of these provisions also applies to those payments as well. So, for example, let's say you got divorced in 2016. Your alimony is deductible, and it's includable for the entire course of your alimony payments. That's whether they're in 2018, 2019, 2020. If, on the other hand, you make a modification to your alimony payments subsequent to 2018, and that modification says that these terms are going to apply, then they're no longer deductible. If, on the other hand, you got divorced in 2019, the alimony is not deductible and it's not includable, period. Okay? So hopefully that makes sense. All right. Let's talk about from AGI deductions here for a second. All right, so from AGI deductions traditionally have come in two characteristics. Either the standard deduction, which is an amount that the government just tells you can deduct, or itemized deductions, which is the total of a bunch of different qualifying deductions that a taxpayer can use in lieu or instead of the standard deduction. So you get to deduct, amazingly, the larger of the two of these. So if your itemized deductions are greater, then of course you deduct your itemized deductions. If your standard deduction is greater, then you just take the standard deduction. Most taxpayers, especially subsequent to the Tax Cuts and Jobs Act, most taxpayers now take the standard deduction. And you will see why when we go through the numbers. Okay, there is one other from AGI deduction, and that's the QBI deduction, and we're going to talk about that in part 3 of this module. So we're not going to get too anxious about the QBI deduction other than to say, hey, yeah, there is. If you look at the 1040, you will see another deduction below adjusted gross income called the QBI, or qualified business income deduction. All right, so here are the standard deduction amounts, and the reason I show kind of the history on this is really to point out, you can see the drastic change between 2017 and 2018, where standard deduction amounts were increased considerably, right? They were nearly doubled in many instances. What happened is there was something called a personal exemption that existed in years 2017 and prior, where for you, your spouse, if filing jointly, and every dependent, you took about a $4,000 additional deduction for them. Those were eliminated and replaced with the larger standard deduction amount. So it's definitely a simplifying term, simplifying provision of the tax law, the new tax law. However, if you happen to have a family with 6 kids, you lost out pretty bad. But eventually we'll talk about the child tax credit and see how that probably offset a big chunk of the problem associated with the loss of exemptions. So Jane's 25, single, and has income of $80,000 in 2018. Julie, on the other hand, is 68. She's also single, but she's blind, and her only source of income is her Social Security income of about $32,000. So the standard deduction normally, right, they're both single taxpayers, right? So let's say in 2018, the single deduction is $12,000. So they would both take $12,000. However, there's an additional standard deduction if you're age 65 or older or blind. And I think the notion is this is trying to create fairness. Now, I have no qualms with giving an additional standard deduction to someone who's blind. I think it's fair to say that their ability to pay is probabilistically almost certainly lower than someone who isn't blind. That's not to say it's always true. It's just the probability is that it's true. Someone age 65 or older, that could have just been based on income, but it's not. And you know how old people, they all vote, and so they have a strong lobby group, and as a result, there is an additional standard deduction for them as well. The additional standard deductions are presented below, and of course you can see they also change by year. A very common element of the tax code is to have cost of living adjustments built into certain items. And so if the taxpayers are married filing jointly, then the additional amount would be $1,300 for each one. So if they were both blind, they'd both get $1,300. If they were both over 65, they both get an additional $1,300. If one is over 65 and one is younger than 65, so like a trophy spouse kind of thing, then they only get the additional $1,300 for the one. If, on the other hand, the filing status, and again, I know we haven't covered filing status yet, but bear with me, we get there. If their filing status is either head of household or single, then the additional standard deduction, for example, in 2018 is $1,600. That's been bumped up to $1,650 for 2019. Okay, and since we're talking about some of these things that have 2018 and 2019 data, since our textbook was built for 2018 data, that's what I'm holding you responsible for, but I feel I feel obligated to present 2019 because many of you aren't even going to graduate by the end of 2019. And so understanding that these numbers change and increase, I think is appropriate. So I'll generally provide them, but I won't necessarily hold you responsible for knowing any of these amounts. So the other thing that often happens now is, are we required to memorize these amounts? And the answer is almost certainly no, right? No, I'm not going to require you to memorize the standard deduction amounts. I'm not going to require you to memorize the additional standard deduction amounts. These things change every year. That would be foolish. If you go to your table pack, you will find these items in your table pack. And yes, you receive a copy of your table pack. I give you one each time you take an exam. Okay, back to work. So when a taxpayer is claimed as a dependent on someone else's return, the standard deduction is limited. So if, for example, your parents claim you as a dependent on their tax return, that means that they're using you for part of the calculation of their tax liability. Now, you may work on your own and have to file your own tax return. That's fine, but what happens is you get a reduced standard deduction. And if you're working VITA this season, you'll see this is one of the biggest problems we have, is we have a lot of student clients who come in and they're like, oh, no, my parents don't claim me. And then their return gets rejected because, yeah, sure enough, their parents did claim them. So something we want to make sure we work out if you're doing VITA. So the limit gets reduced to $1,050. That's up to $1,100 for 2019. Or earned income plus $350 up to whatever that year's standard deduction amount would be. So I have a feeling we probably will do an example of this in class because we're going to run into it in the kiddie tax as well. So think of it as, okay, I'm a 19-year-old college student. My parents claim me as a dependent. However, I work on campus. I make $2,300 a year in 2018. So what is my standard deduction? Well, you'd compare. You'd say, okay, it's either $1,050 or my earned income plus $350. Okay, well, if I made $2,300, then my earned income's $2,300 plus $350. That's $2,650. I'm going to take that as my standard deduction amount because you can take the larger of the two. But let's say, on the other hand, you were really lucky and you had a really great job and you actually earned $13,000 in wages income that year. Well, what would happen is you would look at this year's standard. Well, first, the limit's $10,50. You take your earned income. Oh, I made $13,000 plus $13,50. That's $13,350. But it's limited to this year's standard deduction amount, which, remember, for a single taxpayer would be $12,000. So that would mean that your standard deduction in that situation, where your earned income exceeds the standard deduction, is in fact only $12,000. Okay. And we'll work through lots of examples of that when we go through this module, because I know that can be a little bit complicated. Okay, so something that then comes from AGI after some of these four AGI, sorry, what am I saying? We're in from AGI, is itemized deductions, right? So this is a short list of largely personal expenses that Congress simply has decided, you know what, individuals, you can deduct this. And sometimes it's for policy reasons, sometimes it's for stimulus reasons, sometimes it's just based on ability to pay. And for these, you report them on Schedule A of Form 1040. This is different, of course, than Schedules 1 through 6 that we talked about last module. So Schedule A for 2018 looks like this, and it lists out all of the itemized deductions that are available to you. So you can see up at the top, medical and dental expenses, state and local taxes that you paid, interest that you paid, gifts to charity, so charitable contributions, casualty and theft losses, and then other itemized deductions, which there's a small list of other things that you can deduct. We're going to defer a detailed conversation about what these itemized deductions are, et cetera, I think until Chapter 6, but we should still understand that they're out there and kind of what they represent. Okay, so you would total these. You can see right here on the form on line 17, it says, hey, total them up. and then enter this amount on Form 1040, line 8. And again, if that amount is more than your standard deduction, then that's what you report. If your amount is less than your standard deduction, then of course you just use the standard deduction. Okay, so before we get to filing status, one of the things we need to cover is what's it mean to be a dependent. I've tossed that term around a couple times already, this idea of, hey, you're a dependent of your parents. Well, maybe you are, maybe you aren't. But we need to understand exactly what that is, because you can see already that it has an effect on, for example, the amount of standard deduction you can take. So dependency really is a tax adjustment for a taxpayer when they're providing support to some other human, right? It doesn't have to be a child, right? So really it's meant to adjust for ability to pay, right? So it used to be, again, there were these things called exemptions. Now we're going to see that dependencies affect some other credits, some other deductions, like the standard deduction amount. It also affects filing status. But really, it's ultimately meant to adjust for ability to pay. So again, family with 6 children probably has a higher cost structure than double income, no kids. So Bill is 21, single, waits bar at the Hard Rock for $7.50 an hour plus tips. Julie is a single mom with 3 kids, works as a server at Flo's Diner for the same $7.50 an hour plus tips. And I think the idea is, do we truly believe that Bill and Julie have the same ability to pay? And again, we can dicker about whether that's an appropriate tax policy to follow, right? If you tend to fall more towards the conservative side, you might say something like, hey, that's on Julie. She had these kids. She shouldn't have had them if she couldn't afford them, right? The progressive side, the liberal side would say, hey, it's not about Julie. It's about making sure the kids have meals and food and a roof over their head and they're taken care of, blah, blah, blah. Again, we're not going to dicker about this in this class. We should just assume, because it's true, that ability to pay is baked into our federal income tax system. So these dependencies, again, used to create exemptions. Those are gone. Now they're buried inside the standard deduction. So Bill, he's single. A single taxpayer has a $12,000 standard deduction. Julie would be classified as a head of household, and she has an $18,000 standard deduction. So higher because she is carrying more dependents. She's providing support to other humans. So even though the exemptions are gone, dependency is still relevant, right? We know it's relevant to filing status. It's relevant to the earned income tax credit, which we don't get to, I think, until chapter 14, which is a bummer. It's relative to the child tax credit, which we cover a little bit today, and then again in greater detail in chapter 14, and a few other things. So there are 2 ways to be a dependent under the tax law. You can either be a qualified child, or you can be a qualified relative. And of course, one of the things I find fascinating is that to be a qualified child, you don't necessarily have to be a child. And to be a qualified relative, you don't necessarily have to be a relative. I just think that's hilarious, but classic tax code, right? Also classic tax humor, right? Not particularly funny. So you must have a taxpayer identification number for the dependent. Right? It's not required to be a Social Security number, but you must have a taxpayer ID for anyone you're claiming as a dependent. That's true whether they're qualified child or qualified relative. Okay, to be a qualified child, you have to meet 6 tests. You must meet all 6 tests. Test 1, the relationship test. So the child must be, we say child, qualified child, which is interesting, must be the taxpayer's child, stepchild, adopted child, brother, sister, half-brother, half-sister, step-sibling, or a descendant of any of these. Okay, so you can see it doesn't really need to be your child. Under certain circumstances, a foster child can also qualify. The child must be younger than the person claiming him or her, unless the child is permanently disabled. So, for example, if you ended up in a weird situation where one of your parents married a much younger spouse, and then you had kids again, and you ended up with a stepbrother that was actually older than you, kind of thing. Well, unless that person is permanently disabled, you can't claim them. Okay, test number 2, the domicile, or what I like to call the abode test. Right, so the child must have the same principal place of abode as the taxpayer for more than half of the taxable year. So think of that as meaning the qualifying child, right, again, because it doesn't actually have to be a child, has to live with the taxpayer for more than half of the year. Temporary absences aren't counted. So, for example, if you went away to college, that still counts as living with the taxpayer because that's considered temporary. So, test number 3, the age test. The child must be under age 19, so that's under age 19, not equal to age 19, or be a full-time student under the age of 24. And again, that's under the age of 24, not equal to 24. You're considered a full-time student if you're enrolled full-time for at least 5 months of the year. So if you pull off at least one semester full-time, you can be treated as a full-time student. Test number 4, the joint return test. So this person you're claiming as a child must not file a joint return with his or her spouse. So for example, if the person I'm trying to claim files married filing jointly, that creates a problem. However, there's an exception because, well, there's always an exception, right? So if neither the spouse nor the child are required to file because their income is so low, and we'll talk about filing thresholds in a later chapter, but they file a return merely to claim a refund of tax. So basically they've had tax withheld, but they actually don't owe any tax. Then they are not considered to have filed a return for the purposes of this test. So if the only reason they're filing is to get a complete refund of their tax, then they're not considered to have filed a joint return, and therefore they would pass the joint return test. The citizenship test says the dependent must be a U.S. citizen, a resident of the United States, and that's a tax resident of the United States, not a citizen, right? That's why those are distinct definitions. So must be a resident of the U.S., Canada, or Mexico, or an alien child adopted by and living with a U.S. citizen. So that's in that period of time by which the alien child's been adopted but hasn't quite achieved citizenship. They can still meet the citizenship test. Test number 6 is the self-support test. And this is probably the one that's played with the loosest because it's not quite as bright line as the others. So a child who provides more than 1/2 of his or her own support cannot be claimed as a dependent of someone else. Okay?
What I'm talking about might save your life someday, okay?
Okay, Mr. Mackey, okay?
Okay.
Okay?
Okay.
Okay?
Okay.
Okay. So the idea is, look, if you're providing more than half your support, then you can't be claimed. So this prevents parents from continuing to claim children long since they've stopped supporting them. So support includes expenditures for items such as food, lodging, clothes, medical and dental care, and education. So to calculate support, you use the actual cost of the above items except lodging. The value of lodging is calculated at its fair rental value. Any money that's received by a student as a scholarship, fortunately, is excluded from the support test. So that doesn't have to be included as money they are paying for themselves. Okay, that's the 6 tests to be a qualifying child. To be a qualifying relative, there are 5 tests. So a lot of times what happens is if you fail the qualifying child test, then what you do is revert to the qualifying relative test to see if you meet that. So you must pass a relationship or member of household test. So the individual must either be a relative of the taxpayer or a member of the taxpayer's household. So what does it mean to be a relative? Well, it's not any relative, but it is a pretty broad list. Parents, grandparents, children, grandchildren, siblings, aunts, uncles, nephews, nieces, in-laws, adopted children, those are all qualifying relatives. Foster children also under certain circumstances. They don't have to be a qualifying relative if they're a member of the taxpayer's household for the year. The gross income test is often the one that sweeps out most qualifying relatives. The gross income test says the individual that you're trying to claim as a qualifying relative cannot have gross income equal to or above the exemption amount. Now, I just told you exemptions were gone, But basically, we continue to track the exemption amount for purposes of this gross income test to determine whether someone's a qualifying relative. And in 2018, gross income cannot exceed or equal $4,150. Of course, they also must receive over half of their support from someone else, right? So they can't provide more than half of their own support, but it doesn't all have to come from the individual that's claiming the person as a qualifying relative. So a group of taxpayers can all support this individual. Basically what happens is they generally enter into a multiple support agreement, and as part of that, they agree who's going to claim that person as the dependent. Again, we have the same joint return test that we saw in the qualifying child. And then lastly, citizenship test. It must meet the citizenship test that was discussed under qualifying child. So the last two are basically identical to the qualifying child tests. So every once in a while there can be a situation where more than one person can claim an individual as a dependent. In this situation, if one of them can claim them as a qualifying child, but the other can only claim them as a qualifying relative, then the qualifying child person wins. If that doesn't work, so, oh no, both of us can claim them as a qualifying child, then if one is a parent and one is a non-parent, the parent wins. And then if that's still a tie, then it's the person with the highest adjusted gross income gets to claim the dependent. Okay, you can override tiebreakers with contractual agreements. Again, we discussed briefly this idea of a multiple support declaration, and there's also a form you can file that allows a non-custodial parent to claim dependency. And this is typically, I guess I'm divorced. I guess I'm bored by Form 8332. But this typically relates to divorced parents. Okay. So without the exemptions, dependency is less important. But again, let me point out, and the authors point out, that it also drives the child tax credit. So let's talk about the child tax credit now, because this is such a broad credit that's available to so many taxpayers. So you get a child tax credit of $2,000 per child if that child is under 17. So this has to be a child you claim as a dependent, and they have to be under the age of 17. So if they are 17, you do not get the child tax credit. That doesn't mean you can't claim them as a dependent. You can. You simply can't take the child tax credit. Let's say that you have a dependent, but they do not qualify for the child tax credit. Either they're 17 or older, or they're not a qualifying child. So there could be a relative or your parent. There is an additional $500 credit for each other dependent that you have. So the child tax credit is something that has an AGI limitation, right? Like we talked about with itemized deductions, things from AGI. These apply, but they're pretty generous. So they don't start to phase out until after $400,000 married filing jointly, and then $200,000 for all other taxpayers. So you got to be pretty affluent before you do not get the child tax credit. So I should make a note that all this child tax credit information that we're looking at, it all expires in 2025. And we'll go back to $1,000 per child, and that additional dependent credit won't exist any longer. 2025 is so far away, I don't think it's safe to assume that any prediction about what's going to happen in 2025 should be relied on. All right. All this has led us finally to filing status, although we've discussed some important things along the way. So taxpayers have brackets, right? We know that. You've seen them. Right? They have different brackets where you pay at different rates, right? And if you don't recall those, this would be a good time to take a quick peek at your table pack, because the other thing you're going to see in there is that different taxpayers can also have different filing status. And you'll see that in your table pack, under individual taxes for either 2018 or 2019, there are actually 4 different tax tables. Now, in the last module, we used the single table only. But you can see that there's a single table, there's a married filing jointly table, there's a married filing separately table, and there's a head of household table. And a couple of these actually deal with more than just what's listed in the table. So, for example, married filing jointly takes care of surviving spouse, or what some people call a qualifying widower or widow. And head of household takes care of head of household, of course, and also an abandoned spouse. All right, let's get started with married filing jointly. So married filing jointly picks up two different statuses. Those that are married and choose to file one joint tax return, and surviving spouse, and or sometimes the term is qualified widow or qualified widower. Surviving spouse a little less gender specific, so I've seen a shift towards that term, even though I think the tables still sometimes go qualifying widower. In any event, if you're married at year end, then you are either married filing joint or married filing separate. There's kind of no choice about that, but naturally there's an exception. The exception is known as the abandoned spouse provisions, and what happens is an abandoned spouse, even though they remain legally married, they can file as head of household. So this is a situation where the taxpayer and the spouse lived apart for the last 6 months of the year. The taxpayer at mention is the one that's bearing over 50% of the cost of maintaining a house, and the taxpayer is a U.S. citizen or U.S. tax resident. A surviving spouse is someone who does use married filing jointly. However, surviving spouse is a unique situation. So this is a situation in which your spouse dies during the year and you do not remarry. Okay, so think of that as that's good for 1 year, right? If you're in that situation, your spouse dies during the year, you do not remarry during that tax year, then you are a surviving spouse and you continue to file jointly. And when you think about it, that makes sense, right? We don't have to dicker about whether you died on January 1st or December 31st and what difference that makes to whether you should be filing jointly or as a single, et cetera, et cetera, et cetera. So think of that as that's the 1 year rule. If your spouse dies during the year, you can continue to file jointly as long as you don't remarry. And if you do remarry, you probably still file jointly. It's just you file jointly with your new spouse. So the other way you get surviving spouse is if you have a dependent child living in your home. And again, that needs to happen for over half of the year. And in which case, then you can continue to file as married filing jointly for 2 more years. So think of that as my spouse dies in 2018. And if I have dependent children living in my home, I can continue to file in 2019 and also in 2020. But then after 2020, if I continue to have a dependent child living in my home, I'm going to shift to head of household and away from married filing jointly. So at most, it's only going to last for the 2 more years. Single simply means you're unmarried. Done. Head of household is this special category that is based on, kind of the way that our society has developed. We have a lot more single parents. And so as a result, we have a tax classification for these folks, a filing status. So this is a special category of someone who is single but has a dependent. That dependent does not need to be a child, but you do need to be unmarried on the last day of the year, unless, of course, you're an abandoned spouse, which we talked about previously. That dependent needs to live with the taxpayer, and of course the taxpayer needs to provide over 50% of the cost to maintain the home that they live in. There is one exception, and that exception is, think of it as the nursing home exception, if you need to give it a name. This is if you have a dependent parent. In this situation, they are not required to live in your home. So again, in all the situations, you have to qualify as a dependent, right? So all those same dependency rules that we talked about would apply. So for example, a parent is most likely to be a qualifying relative, which of course you have to provide more than half their support. Of course, they can't have gross income over X. All those things are true. And the unique situation here is with a parent only, they are not required to live in your home. Married filing separately is a little bit of the outcast category. It's generally only better in situations when one spouse makes substantially more. So think of it like Bill Gates and Bill Gates' non-working spouse kind of situation. But even then, it still may not be better. It may not be better to choose to file separately. So, and it has tons of other effects on things that we haven't discussed, but maybe could be discussed. So the capital gain limit. So if you file separately, that actually doubles the amount of capital, sorry, that should really be capital loss limit that you can take. But again, we'll get there later on in the course. The $25,000 exception to passive loss, which presumably you learned something about back in 332 if you took that. But again, we'll cover it later. Married filing separately could both get a $25,000 exception. If one married filing separately itemizes, then the other must, whether they have a greater itemized deduction than their standard deduction or not. And the use of QBI deduction is limited by income, so sometimes you actually want to separate into married filing separately so that only one of the spouses can maximize the QBI deduction as a self-employed taxpayer. Okay. But the reality is, in many situations, married filing separately is really there to handle that kind of ugly time between that last fight and the legal separation. So this is a situation where the spouses really can't communicate reasonably with one another. They're unable to negotiate a reasonable settlement about how things need to work. They're not through the legal divorce process yet, where a judge has told them how they're going to behave. And so they can file separately and that way really not have to engage much with each other. Okay, so I'm gonna jump the gun here. We're gonna bury the lead, and I'm gonna talk about the kiddie tax before we even talk about what creates the need for the kiddie tax. So we'll discuss it briefly now, but later on when we do tax planning and we talk about income assignment, we'll talk extensively about why the kiddie tax exists. So let's start with my sister. My sister is Dr. Collins. She's a dentist. She has her own practice and it generates good income. I made this income number up. I used to do her taxes, but I haven't now for years. But she does okay. I know that for sure. And her marginal tax rate is 37%. So that means she's in the highest marginal tax bracket that currently exists in 2018. So she places a portfolio of investments in her daughter's name, and that generates income of $20,000. So as it turns out, her daughter is 12 years old and absolutely has no other source of income, which would be reasonable for someone who's 12. But notice with our progressive tax rate structure, if a 12-year-old generates $20,000 of income, she's going to be taxed at 10 and 20%. So she's down in the low brackets as opposed to the high brackets. So as a result of doing the shifting, right, so think of it as she probably really still exerts control over her minor daughter. She creates tax savings, right? So the delta between the two tax rates, the marginal tax rates, times the amount of income that's being generated. So just through this little shift, she can save $5,000 in taxes. This is why we have a special tax on children with unearned income over $2,200. In 2018, that's the limit. They're going to be taxed at trust tax rates. So we talked about trusts as a separate legal entity in the previous module. And we even looked at the tax trust income rates and recall they are super progressive. So who qualifies for the kiddie tax? Okay, so again, you have to have that unearned income, unearned income of over $2,200, right? So if you're under 18, or if you are 18 and earned income is less than or equal to 50% of your support, or you're 19 through 23 and a full-time student and your earned income is less than or equal to 50% of your support. In any of those situations, you qualify for the kiddie tax. So as a reminder, here's the trust rate schedule, and you can see that you hit the top marginal rate of 37% at income of only $12,500. So the idea is you can't really shift your income into a trust and hope to shelter it. In fact, you're probably going to do just the opposite. So again, this is a situation where you've found a way for your children, or someone who's under 18, to generate a bunch of unearned income. And the bad answer here is they're going to probably be taxed at the kiddie tax rates. So here they are for 2019. Not that it really matters all that much, but you can see the brackets have slid up just slightly due to cost of living adjustment. Okay, so what is unearned income? So unearned income is income that you generate not from wages and not from a trade or business. And down the road, we'll actually see that wages are treated as trade or business income, which is kind of weird, but it's true. So unearned income, you isolate all the unearned income that the child generates. Then you get to deduct $1,100. In 2018, that's just the statutory deduction. So again, you've noticed that the tax code has kind of these nuisance provisions, right? So look, a kid can have a passport savings account and generate $60 worth of interest income a year. That's not who we're after with this, right? We're after a shift of income from an affluent parent to a child simply because they don't generate any income because they're minors. So this $1,100 deduction is intended to really get rid of any of that noise. And then on top of that, you get another $1,100 or itemized deductions generally associated with unearned income. So first and foremost, I thought I updated this last night, and I apologize, I didn't. 1,100 and 1,100, those are the 2019 amounts. So I updated them, but I should have kept them at 2018. So the 2018 amounts are $1,050 for both of those. So I know when I produce this video, I will put some graphics on top of this so that you're aware. But if you then print off the slides or go back, you may want to cross that out and write in $1,050 for each of those. So let's talk about the $1,050 of statutory deduction. We got that. The greater of either another $1,050 or the itemized deductions directly associated with unearned income. So the reality is, chances are that your minor child doesn't have any itemized deductions directly associated with unearned income, but they could. For example, what if they had to pay state income tax on the unearned income? That is an itemized deduction, and it is possible, if the dollar amounts are large enough, that they might itemize instead of taking this additional, remember, $1,050. Okay. So if net unearned income is negative or zero, then you just default to the regular tax rates. Because, of course, the idea is, oh, wait, well, they don't have any net unearned income. We don't need to worry about taxing it at any special rates. It's just too small. If not, then what we do is we calculate earned taxable income. So that's taxable income less net unearned income. So think of it like we're going to calculate taxable income, and then we're going to bifurcate that into two parts. We're going to calculate the part that's related to earned taxable income, and we're going to calculate the part that's related to net unearned income, and we're going to multiply those using different tax rate tables. So this used to be done differently in 27 and previously, but it's still ridiculously difficult. So we're going to do a bunch of examples together. So Donnie is a child under 18, and he's got $3,200 of interest income and no other income. So you have to just assume maybe Donnie's parents put some money in a money market account or some treasury bonds or something. And so he's generated $3,200 of interest income. He has no earned income because he got no other income at all. So the first thing you would do is you would calculate Donnie's taxable income. Now recall, Donnie's being claimed as a dependent by another taxpayer. So you take his gross income of $3,200 and you would deduct his standard deduction. So recall that Donnie's standard deduction is limited, right? It's either $1,050 or his earned income plus $350 up to the limit, which for a single taxpayer, assuming Donnie's single, would be $12,000. So in this case, it's $1,050. So $3,200 minus $1,050 is $2,150. So now we need to bifurcate that into its two parts. So the next thing we do is isolate net unearned income. Recall that net earned income is the amount of unearned income less the statutory amount less $1,050. So that's $1,100. And now we can calculate the ETI as our taxable income, 2150 less the 1100 of NUI, so that's 1050. And now we simply apply the tax rate. So we would go to Donnie's single tax table. 1100 puts him in the 10% bracket. So 1100 times 10% is $110 in tax. His unearned income is subject to trust rates. Sorry, I just did those backwards, right? So his NUI is subject to trust rates, but even in the trust table, I want to say the first 2550 is subject to 10%, so it's subject to 10%. Then we go to the single table for the ETI. So let me make that clear just to be safe. NUI, subject to trust rates. ETI, subject to taxpayer rates. In our next example, Donnie, everything's the same, $3,200 of interest income, but now Donnie also has $5,000 of earned income. So taxable income is up to $2,850. So that's $8,200. That's his gross income less the standard deduction amount. Okay, so the standard deduction amount here is a little more complex than the previous one. So it's not the $1,050. In this case, it's earned income plus $350. So that's $5,350. That leaves taxable income of $2,850. Hold on one second. I'm closing my door. I feel like I'm in an echo chamber. There we go. All right. So that means that the net unearned income is $3,200. That's the unearned income less the $1,050, less the $1,050, or $1,100. ETI is $2,850 less $1,100, or $1,750. And we can calculate the tax. So the NUI, subject to trust rates of 10%, and the ETI, subject to the single taxpayer rates, also still at 10% if you go to those two tables and look. So total tax, $285. Okay, one more go round. So Donnie's a child under 18, $7,500 of interest income, and $11,000 of earned income. So taxable income is now $18,500. The standard deduction amount is the greater of his earned income plus $350 or $1,050. Clearly that's $11,350. So the taxable income is $7,150. His net unearned income is $7,500 minus the $1,050 minus the $1,050 or $5,400. The ETI is the taxable income less the net unearned income minus $5,400 or $1,750. So the NUI is taxed at trust rates. So now you would need to go to the table and you would see it's $5,400 minus $2,550 times 24% plus $255, and that's just right off the table amount. And the ETI is still taxed at 10% because we're well below the $9,250. Total tax is $1,114. As if that wasn't enough. Let's do one more. So Donnie's under 18, $11,500 of interest income and $12,400 of earned income. So taxable income is $23,900 minus the standard deduction. Okay, so let's think about what the standard deduction rule is one more time. So it's the greater of $1,050 or earned income plus $350. But in this case, earned income plus $350, which would be $12,750, that's greater than the standard deduction amount for a single taxpayer. So as a result, Donnie's standard deduction is limited to the $12,000. Taxable income is $11,900. NUI is the $11,500 minus $1,050 minus $1,050 or $9,400. ETI then is the $11,900 minus the $9,400, which is only $2,500. So again, NUI is taxed using the trust rate tables. I've dropped the rate table on the slide for you. You could see that you would calculate a tax of $1,926.50 if you go through the steps. ETI is still taxed at 10%, the single taxpayer rate. Up to $2,500 is only 10%, so the total tax $2,176.50. Okay, so technically the kiddie tax rules are not done, but we are going to be done. So there can be differences in the way this is calculated when earned income is really high, for example, over $70,000. And there can also be a different way of calculating the net unearned income tax if that unearned income is of a special rate variety. For example, qualified dividends or long-term capital gains, which are eligible for preferential rates, then the way it's taxed would be a little bit different. So we're not going to get mixed up in that other than to note that that is in fact the case. All right. Let's do a quick overview of business entities. For those of you that have taken 332, this should be redundant. For those of you that haven't, this will be new material. Okay. So business income is reported differently for different business entities. So let's say that you're a sole proprietor. Well, a sole proprietor completes a Schedule C, which is net profit for a sole proprietorship, and that's simply part of their individual return. We looked earlier at how Schedule C tied in to Schedule 1, which ties in to Form 1040. A corporation, so let's say you're operating that business through a corporate form. Corporations file their own separate tax return. It's a separate entity, a separate tax-paying entity, and so therefore it doesn't land on the individual return unless that corporation happens to pay dividends, and it would just be recognized as dividend income. If the business is being operated through a partnership, the partnership completes Form 1065. That information, that form is informational only. What's called a Schedule K1 is given to each partner or owner, and they end up reporting those items on their individual returns or potentially their corporate return if the partner is a corporation. Same with an S corporation. They do a Form 1120S. An S corporation, that's an election that a corporation can make to be treated as a flow-through. And again, it does the same thing. The form number is different, but basically you calculate it for the entity and then you allocate it to each of the individual shareholders so that they can report those amounts on their individual tax returns. That typically goes through a Schedule E. And then lastly, limited liability companies. They're typically taxed as partnerships, and so they file partnership tax forms. A limited liability company can also be a disregarded entity, and it can also be a corporation. It has the opportunity to check the box and be a few different things. If it's a disregarded entity, then it's treated as either part of the corporation itself, or it would be treated as a Schedule C for an individual. If it's a corporation, it's treated like a corporation. If it's a partnership, it's treated like a partnership. Okay, so when we think about gains and losses, recall we had an example earlier in this video where we talked about Ren buying stock and then the price of the stock going up and then Ren selling the stock. So it's the sale of that stock that created the gain in that instance. So you need a realization event to create a gain or loss. And then what happens is those gains and losses can be characterized differently. So character refers to classifying income in different ways. And most income is ordinary income, but there's also capital gains and losses. And that comes from the sale of capital assets. And what happens is the treatment and taxation can differ. For example, long-term capital gains enjoy preferential tax rates. So it's either 0, 15, or 20%. And it depends on the amount of income that the underlying taxpayer has. Short-term capital gains, however, are just taxed like regular ordinary income. And that's using those single married filing joint tax tables that we've used before. Net ordinary losses can offset ordinary income. However, net capital losses for an individual are limited to only $3,000 per year per taxpayer. And married filing joint also only gets $3,000 per year, even though technically that's two taxpayers. Okay, so one last thing in this particular Part 1 video is a few of the individual logistics, and we'll spend a little more time on these in future chapters, but an individual tax return is due the 15th day after the end of the year of the fourth month. 15th day of the fourth month after year end. And since almost all individuals are calendar year end taxpayers, that's April 15th. Partnerships and S corporations, so these flow-through entities, their tax returns are due the 15th day of the third month, which would be March 15 for a calendar year end. The idea being, therefore, that information is now made available to the individuals and corporations so they can report it on their tax returns and therefore pay taxes because they are the tax-paying entities. There are extensions available to both. Those extensions are generally for 6 months. In the old days, you used to have to file for a reason. They're pretty much what they call an automatic extension today, which means you still have to file for the extension, but you do not need to get approval. Again, that's 6 months. So for a partnership or S Corp, that would be through September 15. And for individuals, that's through October 15. That does not, when you file an extension, or when you file for an extension of your individual tax return, that is not an extension for your payment of taxes. Taxes aren't really due at the time of filing anyway. Technically, they're due by January 15th of the year following. Individuals are required to either have withholding or make estimated tax payments to pay all their tax, for the most part, all of their tax, by January 15th of the year after the tax year. Corporations are required to pay their taxes by December 15th of the actual tax year. Not if year, but of the tax year. All right, that brings us to the end of part 1. We have 2 more parts to go, so buckle